having watched markets as an economist for 35, 36 years, the uncertainty levels are still unprecedented. I can't think of another time. There's not a comp anywhere in economic history I can think of since really the Great Depression that we can look to.
One of the big things that's different this time is the composition of our investable universe in the listed market. So I'm going to show you some data here. And, the global real estate securities universe is much more diverse today than it was. So it's the four major food groups, which are on the left side of that chart: office, residential, retail, industrial, represent a lot less of our investable universe today than they did back before the financial crisis. So we're showing you all of those specialty sectors in the circled bars on the right, and you can see that today the specialty sectors, the non-traditional sectors, represent over 60% of our investable universe. So within those specialty sectors, we have cell tower companies, data center companies, self-storage, healthcare, single-family homes for rent, among others. Coming into the financial crisis, there was we had specialty sectors, but it was less than half of what it is today. And I point it out because many of these specialty sectors are acyclical, and we believe will be less dislocated by the pandemic. Some of them, in fact, we think may even see demand increase, like cell towers and data center companies. Others within this category, won't grow as fast that we might have expected before the the crisis, but I think they'll be fairly resilient. I would put storage, single family homes, manufactured homes, medical office buildings in that category. And then, some of these specialty sectors that make up the 60+% of the universe that are typically quite defensive in downturns today sit right in the bullseye of the virus threat. So that would be student housing, senior housing. There we expect significant disruption, at least in the short term.
So really quite a range within that specialty sector group. But before we go to Matt on international, how about the traditional sectors, Lisa? Any surprises there?
Yeah, in the traditional sectors, I think we share what is very much a consensus view at this point, that the retail sector will be the most impacted. The events that we thought might take a decade or more to play out appear to be happening in a matter of months. And that's where we've really brought our valuations down the most. So, we've lowered our short-term, intermediate-term, and long-term cash flows. We've brought up our risk premiums there, and we've made a material move down in our view of intrinsic value in that sector. After retail, I'd say we see office as potentially the most impacted by this disruption. And here it's really about less about the short term and more about the long term or the intermediate term. And specifically, we've lowered our long-term growth rates in the office sector to reflect what we think will be a permanent decline in demand, at least on the margin, as more people work from home more often. Thinking about multifamily, I'd say it's somewhere in between the short term and the intermediate term. We do think there'll be some disruption there, but longer term, we really don't expect an impact on values. And then industrial, again, I think this is a fairly consensus view, is the best positioned of the major sectors. And although we don't think it's immune, especially in the short term, from the typical effects of a recession on consumption and trade.
How do your clients think about investing in securities? Is this a sort of a tactical play? Real estate is on sale at a markdown of 30% to intrinsic value or 16%, and so come on in tactically. Or is this a good strategic play? How do they think about it? How do you think about it?
Yeah, well, I'll jump in and take that one. I would say most of our clients fall into the strategic long-term bucket, meaning that they have made a permanent allocation to real estate securities. And Jacques, this won't surprise you, but we think this makes a ton of sense. So, real estate securities, you said it, they're real estate, and the public and private markets are very complementary. You nearly double your investable universe when you invest in both the listed and unlisted markets. And, the public market actually gives greater access to some of the specialty sectors that are really hard to access privately. So we are big fans, no surprise, to the permanent allocation. Having said that, we also are firm believers in the tactical play, and we think, and we have data to prove that tacking on a tactical strategy can, even on the margin, can meaningfully increase risk-adjusted returns from real estate. So Jacques, I'm going to show you some of your own data that you put together here. Here we are looking at the correlations of returns between the private and public real estate markets. The purple bars there are the quarterly correlations. So you can see those are relatively low in the short term. The light blue bars are the 5-year correlations. So that's a holding period that's more akin to what a private real estate holding period would be. And you see the correlations are much, much stronger on that basis. But finally, look what happens in the dark blue bars when we take those same 5-year correlations, but we lag the public market returns to better align with the private market real estate appraisal process. And you see there the correlations are nearly perfect. So this is showing us that listed real estate and private real estate will perform almost identically over the long term. However, we know that over the short term, performance can diverge and sometimes meaningfully, and that's what's going on today. So we really do see this short-term mispricing as an opportunity. And Matt just showed you the data that shows that when discounts are meaningful or premiums are meaningful, that is a very good indicator, a strong signal for subsequent outperformance in the case of discounts. So back to your question about our clients, we are seeing some of our more opportunistic clients making new allocations or topping up in a tactical fashion. This arbitrage opportunity that we're trying to highlight today is definitely getting more attention. And frankly, it should. There are very few free lunches in the investment world, and this is one of them. And we'd like to see more of LaSalle's private equity clients avail themselves of this opportunity.
Okay, Lisa, you lay out a pretty compelling case. I remember my econ professors at MIT saying there really is no such thing as a free lunch. There's an efficient market, and go outside and look for that $100 bill on the sidewalk. You won't see it. There's a reason for that. Or the joke was you'd see the $100 bill and you wouldn't stoop to pick it up because it couldn't have been there, right? So Matt, if it's such a compelling case, what's going on? Won't it adjust pretty quickly? And is it really a temporary dislocation, or is this talk to us a bit about why aren't more investors taking advantage of this? What's holding them back?
Well, Jacques, a common concern is the volatility. But as you know, and we've discussed this at your Kellogg class, volatility is not necessarily risk, and it comes with liquidity, which is a really good thing. Volatility and the liquidity to transact, really, it allows you to take advantage of opportunities in the market. And at times like this, that really is a feature, not a bug for REITs. And whether you're using that liquidity to take advantage of opportunities, take advantage of the mispricing available, or that liquidity could provide you the chance to really avoid portfolio torpedoes, which can really affect the long-term returns of a portfolio. And that all really underlines that it's a time to be active in the REIT space, which we have certainly been. Our trading turnover is up 90% in the first quarter, year over year, and that action is really benefiting our clients. And overall, the liquidity of the REIT market is clearly up during this period of time, which frankly compares pretty starkly to the private market, where the liquidity is down. You might not like the price when prices are down, but you can transact. And being able to get your money back when you really need it, that has real value. And that's a real great feature from the REIT market.
Matt said it earlier, timing markets is inherently difficult. And we've brought it up again and again. There is a lot of uncertainty out there. But, we have taken our valuations down meaningfully. Matt said our NAVs are down an average of 15%. And even on that basis, we see that the sector looks cheap as compared to the private real estate market. And we also see strong valuation signals when we compare to real estate securities to other alternatives, equities and bonds. So, for investors with a long-term view who can tolerate some near-term volatility, I agree with the point you made earlier. We are going to, this will be a bumpy ride for a while, and headlines will be moving and sentiment will be moving these stocks around. But we think today is a good entry point.
Price discovery is happening every day, every hour with these listed stocks. You know exactly where you stand in terms of pricing, your entry point. You know what happens after you buy the stock, and you've got great data to look at, back through time, and great information by sector and by country, with a lot of information flowing into building a real estate securities portfolio. It's clear, you've showed us that there's been repricing down about 30%, down another 10% just last week from their levels just the week before. And the repricing that we're waiting for in private equity land, you've already had it. So clearly there's a tactical reason to consider just in terms of thinking about all the clients we have that focus mainly on private equity. That, as you said, Lisa, this is looking like, for at least real estate securities, an outstanding vintage year, a good timing opportunity. Don't know if we can say that yet on private equity. I think it'll take a lot of time before sellers and buyers meet and there's capitulation in private equity. But here you've got a lot of, as Matt said, a lot of movement. All the volatility is also liquidity driven. There's movement in and out. You've also mentioned that there's a strategic reason to be looking at these companies. Many of them do very specialized things in specialized geographies. They know what they're doing, particularly when you think about some of the things you mentioned, Lisa, with student housing, with data centers, just in terms of the knowledge that the management brings to it, that is specialized knowledge, perhaps not easily found, and really being able to find an owner operator who also can run a data center in private equity land is hard. But you have, whether it's life sciences or student housing, you have management and assets together that can really supplement a private real estate portfolio when some of those sectors are hard to find, particularly the specialized ones. I think the final point I'm taking is this idea that there's mispricing, that our research and your research does say that this is going to be a tough recession, probably tougher than any we've seen since the Great Depression. We need to be sharpening our pencils as we calculate our occupancies, our rent collection, our all of the metrics that go into those valuations that you do on listed companies and our teams do on private equity. But there's going to be dislocations, and in some cases, your sector is overreacting to some of these headlines. I feel sure that's a lot of what was going on last week, in addition to the earnings surprises that you mentioned. And I guess my thought here, as a parting thought, is that it takes a real pro, someone who's in the market, watching these companies every day, listening to their earnings calls, already with a model built prior to the earnings call with an expectation, and able to move very quickly after the earnings call or after the movement in price. I think, Matt, you told me that some of these names, some of these individual stocks back in March were moving up and down in the course of a trading day, double digits, 10 to 15%. So I guess my conclusion here is this is not amateur hour. Don't try this at home with your e-trading account, particularly for active management. This is a great time for active managers to move quickly and to really do what they do best, which is, I think, what both of you are doing. Congratulations for beating the index so far this year by a substantial sum. And really, thank you to everybody for listening in. And thank you to Lisa and Matt for sharing your knowledge and expertise with us. To those listening on the call, we look forward to hearing from you. As we said at the beginning of the call, please send us a question or comment. We'd love to hear back from you. And thank you for listening today.
Thanks. Bye.
Thank you, Jacques.